Good evening. Welcome to our Mississippi State Alumni Homebuyer Workshop. Great to be with all of you this evening. Thanks for tuning in to our class. Tonight, we're going to walk through home buying and what it looks like for you as a first-time home buyer. So this is a very interactive class that we do for our alumni partnership. This is a class we provide 4 times a year. It's basically a quarterly class that we help you kind of really understand tools and resources that are available to you in home buying. We're proud to be a partner with the Mississippi State Alumni Association, and we, in partnership with them, provide these classes to you as kind of just more valuable resources for you. And then hopefully our goal is part of our relationship with working with you in that journey towards homeownership to be a partner with you when you decide to purchase a home whenever that time comes. And again, my name is Jason. I work for an organization called American Pacific Mortgage. We're the 9th largest mortgage lender in the country. And our team in particular partners with alumni associations like Mississippi State to provide home buyer education resources. Now, tonight's class is going to be very interactive. So as we go through tonight's class, I encourage you to ask questions of us. We'll be talking through some key points tonight, which I have on screen around, housing market. What does it look like? We're going to spend some time talking a little bit about interest rates. Unfortunately, not the greatest of news in interest rates today, but we'll kind of talk to you a little bit about what's happening with interest rates. From there, we'll go into the kind of really around credit, and we'll talk about, what are some areas of opportunity for me with my credit score to help improve it as I prepare to purchase my home. We'll also talk about different programs that are available to you. And as you prepare for homeownership, how do you save for homeownership? So in the program segment, you're going to learn a little bit more about the minimum down payments to purchase a home. Well, we'll talk more about how do we save for homeownership. Also talk a little bit about first-time homebuyer programs that are available to you in your local market. We are a nationwide lender, so we serve our communities all across the country. Depending on where our class is thinking about purchasing, there'll be particular first-time buyer assistance programs available in your local market. And then finally, we'll wrap up tonight's class by talking a little bit about the buying process. So if you're interested in taking the next steps in homeownership, we'd encourage you to get connected with us after tonight's class. And part of that is kind of walking through the buying process. Now, I'm going to give you kind of a visual tool to better understand the buying process tonight, but that's a great way to kind of get on that path towards homeownership is to get connected with us for a free consultation. All right, well, let's go ahead and dive into our classwork. And, as we think about buying a house, this is probably going to be one of the largest financial decisions we decide to make. When we think about home ownership, there's a lot of great benefits that come along with it. And I thought I would highlight some of those for you now. When we think about home ownership and we're probably transitioning from renting to owning, there's an opportunity to create hopefully better affordability for us. And we're not waiting for a landlord to increase rates of rent on us, right? Because now we have a fixed payment that we're electing on our mortgage. Even though we're in a high rate environment still in today's market, there will be opportunities for us to help lower our monthly payments. We call that refinancing your home. And those are things that you can do as an existing homeowner. So if you purchase a home at a 7% interest rate and rates at some point drop to 6%, you could refinance your home to hopefully create better cash flow or a lower overall monthly payment for yourself. Now, purchasing a home is an asset. And for most of us, it's probably our number one asset that we have, aside from maybe a retirement account that we own. So this asset should appreciate over time. So as I pay down the balance of my home, as the home value hopefully grows, the difference between the value of my home and what I owe on it's called home equity. And like I said, that's one of the biggest assets for most of us that are homeowners across the country. This is an asset that could create generational wealth for some families. So, purchasing a home, while it's a big financial commitment, there is a tremendous upside for us when we take on home ownership. And believe it or not, there's some tax benefits that would come along with owning a home. Potential tax deductibility of interest, which is huge for a lot of us. And when I decide to make energy efficient upgrades to my home, there can also be tax benefits for that as well. Well, when we're considering home ownership, a great way to launch into kind of figuring out is it right for me or not is to take a look at a rent versus buying calculator. That's one of the tools that we have at the disposal of our clients. I think it's a great way to really help better understand how home ownership can help you from just an overall kind of growth in financial position, if you will. Now, beyond our rent versus buying calculator, which I'm going to take you through in just the next couple minutes, there's some other great tools that we offer, things like our affordability calculator, payment calculators. When we're homeowners at some point in time, a refinancing calculator. So I encourage you to check that out when you have some time. But let's walk through this buy versus rent calculator. I think it's, again, a great tool to launch us into kind of thinking through homeownership a little bit more. So let's make the assumption that we bought, let's say, a $275,000 home, right? And with a $275,000 home price, the minimum down payment is 3%. And we're going to talk more about that in our products segment tonight. But that means we would finance $266,750. So that's 97% of that purchase price. We have interest rates of average of 6.25, and that probably changed a little bit today, but nonetheless, we'll put 6.25 in there. We have a 30-year fixed mortgage as our product selection, and then we'll make the assumption that we're going to purchase sometime in the month of April. Now, for us attending tonight's class, there shouldn't be any urgency to purchase. Your timeline differs for everyone, but ultimately, this kind of gives us, kind of the framework, I guess, for what our budget's going to look like for home ownership. So if we assume we purchase in April, if we put less than 20% down, we put 3% down, we are going to have mortgage insurance. And we'll talk more about mortgage insurance in just a bit. But ultimately, mortgage insurance is insurance that protects the lender against default by the buyer. We factor in the tax rate of my home. If I'm buying a condominium, maybe a townhouse, we have HOA dues. And then we also want to make a few assumptions around what tax bracket I'm in, how much the repair costs are going to be for my home on an annual basis. Eventually, I'm going to sell my home. So what are the selling costs for that? And then my appreciation for my home. Now, for those of us that are going to look in different parts of the country, not necessarily just Mississippi, appreciation rates obviously differ in different parts of the country. So whether you're buying in California, Kansas, Florida, or Mississippi, all those appreciation rates look a little bit different. So we're going to compare home ownership now against renting. So let's assume that we're paying like $1,500 a month in rent, that our rent insurance costs are 1.2% of our overall rent costs. And then we have our rent expected to go up about 2% every year. All right. So what we're doing here now is we're seeing, okay, well, if I continue to rent for the next X amount of years at $1,500 a month, how does that stack up versus owning for the next several years? Well, if I look at buying today for $275,000, my break-even point is 3 years. So what that means is the investments I make in down payment offset with tax deductibility, appreciation. After 3 years, I'm going to break even in ownership versus renting. We generally would love to see our clients break even in less than 4 years. And of course, hitting the 3-year mark is definitely a win for our clients. Now, where it gets a little bit more exciting is now we start getting past the 3-year mark, and then we get into kind of more of positive appreciation or financial gain in home ownership. So 3 years is my break-even mark. What if I look out to 10 years? Well, if I put side by side 10 years of renting versus 10 years of owning, I have an $86,000 buy opportunity of owning my home versus deciding to rent for the next 10 years. And you're probably paying someone else's mortgage. But that is really, truly the magic of home ownership. When I think about appreciation, when I think about tax deductibility, that's where it's going to make the mark for me financially. So I would encourage our class, if you have some time, take a look at that calculator because I think that's a great way to help frame up home ownership for you. By the way, I forgot to mention that all of our material from tonight's class, we're going to share back out with all of our signups from this evening. So you'll get all of our presentation material as well as tonight's class is being recorded. That'll be up on our YouTube channel tomorrow. So feel free, if you have to step away from your computers, you want to look back at our recorded version, you can certainly do that. All right, now let's kind of pivot a little bit from rent versus buying talk to talk more about the housing market. What's happening in the Mississippi market? Well, all across every market in the United States, we're going through a little bit of a lull before we head into our spring and summer buying months. Generally, that's going to start next month, where we get a little bit more active in the market because weather's getting nicer in most parts of the country. We're starting to see some warmer weather. That means sellers might say, hey, gosh, the sun is shining a little bit more. I think I want to put my home on the market. That gives us more opportunities for buyers to engage with sellers to purchase their home. And buyers may be thinking about they're moving their family to a certain part of town for a different school district. We might see an employment relocation, a whole variety of reasons why we might be considering home ownership during the spring and summer seasons. But that's generally when it's a little bit busier this time of year. Now, what you can see in the Mississippi market over the last 3 years, you can see a little bit of downward pressure on prices as we kind of started out the new year. But now we're starting to see some pickup in the market. Now, average price across Mississippi is just over $260,000. You're seeing a lot of kind of more homes stay on the market longer, 72 days, average days on market. One of our challenges has been over the last couple of years is just to have enough supply available to us. And now we're starting to see a little bit more supply. In fact, we're seeing a little bit of a back supply in some markets. If you're not just considering Mississippi, other markets like Colorado, Texas, Georgia, Florida, those are all seeing a lot more supply numbers come up. So for buyers in those particular markets, they have a lot more to choose from, and they're able to negotiate a little bit more with sellers. But we are seeing a little bit of more of a shift in markets. And supply has been the biggest challenge for most markets. It's just we haven't had enough options for our buyers that are entertaining homeownership. The other element to considering homeownership is interest rates. What are interest rates doing right now? I mentioned it earlier before we launched into tonight's classes. We had a little bit of a rough day in interest rates. Unfortunately, we're seeing some of the metrics that we really count on for interest rates starting to come down, which is leading us to believe that interest rates will go lower, which they hopefully will. But unfortunately, we're right now in the middle of a conflict in the Middle East, which is casting a little bit of a cloud over the financial markets, especially as it relates to oil prices. Oil prices are almost double what they were before the conflict started on February 28th. So things have changed quite a bit, and unfortunately, we're seeing interest rates start to rise right now. So interest rates probably went up another 0.125%. Average interest rate is probably closer to 6.5% after today's financial trading day. So obviously, things are going to remain a bit volatile in the markets until we kind of figure out what's happening globally. We're have a keen eye on it. That's one of the things that we're doing is we're kind of guiding our clients. I've had several conversations with clients today, helping educate them on what's happening in the markets, and more than likely looking into locking their interest rate today because we can protect their rate against the downside in the market. It's important to understand as prospective buyers is that interest rates change by the minute during the financial trading day. So interest rates may look one way at 8 o'clock in the morning. They may look completely different at 2 o'clock in the afternoon. So we really have to watch that very carefully, especially, the markets are just not in this linear pattern. Markets can change really quickly. In fact, we saw that today with some negative pressure on interest rates. This is a snapshot of interest rates over the 12 months that we've been doing our look back here. You can see kind of interest rates ticking up as of March 9th. You can see our kind of hovering just under the 6.25 threshold. We probably broke through that 6.25 today. We were in a really nice little pattern down here. Interest rates were set to go below 6%, but unfortunately couldn't break through that with what's arose over the last couple weeks. As we think about interest rates and how that factors into what my selection is for interest rates, I think it's important to understand that there's different characteristics that make up an interest rate, things like credit score and your eligibility for a specific product, the loan program that we're going to do, what my down payment looks like, how much I decide to finance. You can elect to pay points to bring down your interest rate. So if you're trying to target a certain payment and maybe the market interest rates just aren't quite there yet, you do have an option to pay more funds out of pocket in order to bring down that interest rate. We call those points. Usually 1 point is the equivalent of 1% of your loan amount, and that'll help bring down your interest rate about 0.25%. Another way to bring down your interest rate is by shortening the term of your loan. Now, traditionally, especially as us being first-time buyers, we're going to elect a 30-year fixed mortgage product, but let's say I switch to a 15-year fixed product. That could potentially lower my interest rate maybe 0.25%, perhaps a full 0.5% in what my offering looks like. Ultimately, as we meet with you to design your home buying plan around home ownership, we're going to figure out what the best program is for you and that corresponding interest rate, because as I mentioned earlier, we want to be kind of strategic in how we navigate these markets, especially if we're thinking about buying over the next couple months, because obviously the interest rate and financial market's going to remain a bit volatile for the near term. Now, when we're looking at financial products and targeting, interest rates and whatnot, credit plays a major role in the selection of those elements in home buying. Every program has a minimum credit score, and we've put those programs up on screen. And when we look at the credit reports, or credit scores, I should say, we're taking the middle score of all three agencies that report out. Now, those three agencies are TransUnion, Experian, and Equifax. We're taking the middle score. So what that means to me as a buyer is if my highest score is 760, let's say my middle score is 740, and then my lowest score is 720, we're going to take that middle score of 740, for qualifying purposes. And why that's important to us as buyers is because that can drive what payment I'm going to have with my interest rate selection. That can drive my program, can also drive the cost of mortgage insurance. So it's really important to optimize credit scores. So that's one of the things we'll talk through in tonight's class is like, okay, now we know more about credit and how it impacts me. What are things I can do to help improve my credit score? Now, we look at the lowest middle score between both borrowers. So if my middle score is 740, but let's say my partner's middle score is 720, then we take that 720 score when it comes to qualifying and the product selection, interest rate, mortgage insurance. So that's really important to understand. And as we consult with you for your home buying plan, we're going to figure out ways to hopefully maximize your credit score. If you've had more recent challenges with your credit score, let's say you've had some recent late payments, those late payments are going to affect you in the most recent 12 to 24 months from the date of the late last payment. So if I missed my student loan payment in October of 25, well, that's only like 6 months away, right? So it's probably going to negatively impact your score right now because we're inside that 12-month window. As I get further away from that event, then the kind of more improvement I'm going to see to my credit score. Now, if I have other things on your credit that are appearing as negative items, this matrix will kind of show you how long they'll retain on your credit file. Now, credit inquiries, while they're not negative items, we just want to be mindful that we don't have too many inquiries because those can set back your credit score. There are rules in place for credit scoring for mortgage and auto financing that it allows me to have a 30-day window of time to shop around with as many lenders as I want on hard inquiries, and it's the equivalent of one credit inquiry impact to my credit score. Now, in our process, we do things a little bit different. We actually start with a soft credit check for our clients. And the reason why we choose to do that is because soft scores do not, or soft credit checks do not impact your credit score. So when you decide to take the next steps with us and do a consultation with us virtually, when I get a chance to review your credit, that will only be with a soft credit check. Now, there are 3 different models to credit scoring. There's credit card modeling. By the way, credit card modeling score is what's used for your services that help you monitor your credit. And of course, there's auto financing and then there's mortgage financing. We're going to use the mortgage financing model, which I've outlined here for you. And I want to kind of walk you through different areas of that model. One is going to be how long have I had credit? So that's a 15% weighting of the credit score. And then I have how much new credit I'm trying to get access to. So if I'm opening a bunch of new accounts, if I have new hard inquiries on my credit, that's a 20% weighting of the score. And then this area is probably the biggest area of opportunity for most clients I work with across the country, which is around revolving debt. So it's looking at how much credit am I carrying in my balances versus my credit limits. The optimal level of credit balances to credit limits is 10%. If we're running higher than that, let's say 80% utilization of credit, our goal should be to try to get to 50% or less. The next benchmark would be 30%, and then we want to get to 10% or less in credit utilization. Here's a tip for you to help you manage credit card debt. So if you look at your credit card statement, there's a due date, and of course, there's a billing statement date. I want you to take a closer look at the billing statement date because what that is, that's the date when the credit card issuer closes out the activity from the preceding 30 days, and then it closes out the activity and reports it out to the credit bureaus. So my tip for you tonight is that if you could pay off or pay down that credit account before the billing statement ends, you're going to lower your utilization before the reporting goes out, and of course, hopefully increase your credit score. Last component is going to be payment history. That's how I've paid my bills. Late payments are rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. The more significant on that late pay scale, the bigger impact I'm going to have to my credit score, especially in the most recent 12 to 24 months. All right, we're going to kind of segue from credit, but kind of still stay in that same genre because we're going to talk about student loans. Student loans are things that we have conversations with clients about in our consultative process. Student loans come up in the qualifying, and I think it's important to understand that if you're not in active repayment right now, so whether that's deferment or forbearance, we still have to count a minimum payment for qualifying. So on a student loan situation where if I'm not paying actively right now, then on a conventional loan, we count 1% of the total balances as the monthly payment. If I'm doing an FHA loan, it's 0.5% of my balances. And so we really want to kind of talk through that a little bit. Even if you're back in school and you're on deferment, we still have to have a minimum payment for qualifying. Now, if you're in a savings plan, that's great. If you have $75,000 worth of student loan debt and it's on that savings plan at $250 per month, then that's the payment we'll use. when it comes to qualifying for your mortgage. Some of our clients are on public forgiveness programs. That's great. They do generally forgive after 10 years. However, if we're at year 5 of that public forgiveness program, we still have to count a minimum payment for qualifying. The reason why we have to do that is because every loan program does have underwriting guidelines that are attached to that program. That program. And I wanted to share with you some of those programs right now. 4 of these 5 are really some of the ones we're going to lean into when it comes to designing our home buying plan. The first program is a conventional loan. That's Fannie Mae and Freddie Mac. You may have heard them talked a little bit about in the news. Minimum down payment of 3% for a first-time buyer, up to the conforming loan limit of 832,750. For some of us that want to buy in high cost of living markets, maybe some of the Virginia markets, Chicago, California, New York, those markets have high cost of living areas that can go beyond that conforming loan limit, but the minimum down payment jumps from 3% to 5%. Next product is an FHA loan. That is a government insured loan. FHA stands for the Federal Housing Administration. Minimum down payment of 3.5%. Loan amount's a little bit different with FHA because it's set by the county that you're going to purchase in. FHA does have the lowest minimum credit score requirement, which goes down to a 580 credit score for eligible buyers. FHA is going to just allow a lot more flexibility than probably what we'll see on the conventional side of products. Maybe if I had a late payment on that student loan in October, I could probably get through that with FHA. Might be a little bit more challenging from a conventional loan perspective. Now, both FHA and USDA, which is noted below here, are both government insured programs. USDA is going to be more designed for clients that want to purchase in rural areas. There's 2 qualifiers to the USDA product. Location of the property has to be deemed as a rural property. Also, there's income limitations by the household size. And then the VA home loan product allows our veterans to purchase that have that VA home loan eligibility. Great product to have entry to home ownership for the veteran, a little bit more flexibility from a guidelines perspective. And there really is no maximum loan amount for the veteran and a 0 down payment option. Last product is a jumbo home loan, not typically the entry point to home ownership for most buyers. It's more of a building block loan from a entry level loan product like conventional or FHA. Jumbo is going to be for clients that need a little bit more financing that stretches beyond the conforming loan limits. Now, within loan programs and putting less than 20% down, there's a thing called mortgage insurance. And I wanted to spotlight for you both PMI, which is private mortgage insurance, and then MIP, which is mortgage insurance premium for government insured loans. Now, what both mortgage insurance lines do is they basically insure the lender against default by the buyer. On PMI, it's called private mortgage insurance because there's basically private mortgage insurance companies that insure the lender, whereas on the government insured side, they are FHA-backed loans. On a conventional mortgage insurance calculation, we look at down payment, credit score, and how much you finance. With the conventional loan, it does have a cancellation option that once I reach 2 years in my loan and 22% equity, I can apply to have my mortgage insurance canceled. And you can see what that calculation looks like for mortgage insurance on screen. If we take a look at FHA, that's a little bit different because we have 2 elements to mortgage insurance. We have upfront mortgage insurance, which is 1.75% of the loan amount. And then there's monthly mortgage insurance, which is 0.55% of my loan amount. And then, of course, we divide that by 12 to figure out the monthly cost to the client. Now, FHA is a little bit different than conventional because there is no cancellation option in the FHA product set. The only way for me to exit the FHA mortgage insurance if I was to refinance out of that loan into more of a conventional product. So we look at FHA as more kind of the interim product for our clients. If they're facing credit challenges, maybe lacking down payment, maybe there's some little more flexibility we need with qualifying. FHA is a great tool to help us entry to home ownership, but probably not going to be the long-term option. As we improve our credit, as we see more equity in our home, we're probably going to transition to more of a conventional product in a refinance. And you can see the calculation of FHA, MIP, at the bottom of our screen. Well, as we build a plan for our clients for home ownership, we also take a look at validating income because income is important to really understand, how we can support this monthly budget that we're taking on with home ownership. Here's what some of the documents look like that we're going to ask for in the home buying process. So you can see, last couple of years of W-2s, recent pay stubs, and then from an asset perspective, some of the bank statements. So those are generally the documents that we need. Now, As we think about qualifying for homeownership, I wanted to share with you a couple ideas around that because there's a little bit of misconception in the marketplace about how can I qualify based upon my job history or whatnot. We do have to validate 2 years of work and or educational history. Doesn't mean I have to be on the job for 2 years. I could have graduated from Mississippi State last fall and now I just started my job January 1. Well, I could probably be eligible for financing. As a lender, we just have to piece together 2 years of work and or educational history. I can also be in a situation where I've been in the workforce for a little bit longer, maybe it's 6 years, and I'm now transitioning to a new job, but I want to use that new job earnings to qualify for my mortgage. You can certainly do that as long as we have an executed offer letter. Now, if I have variable compensation components like maybe overtime, bonus, commissions, that's a case where I have to have 2 years on my job because we want to take those earnings for a span of 2 years, then we average them over 24 months to show how much we can use of those earnings to factor into your income for qualifying for your mortgage. If you have a dual employment, let's say you're in the healthcare industry and you work for two different clinics, right? If you're in a situation like that, that is another example of where we have to show that we have 2 years between both jobs in order to count both sources of income. If I'm self-employed, I have to have 2 years of tax filings. If I'm an independent contractor, that's still self-employed. I'm receiving that 1099, and then I'm probably filing what we call as a Schedule C on my tax returns. That requires us to look at 2 years. And then finally, some of our clients will have a 40-hour work week job, but they also drive for Uber or Lyft on the weekends or do DoorDash, right? That income can be considered on the side, but same kind of principle. We have to show that we've been doing both jobs simultaneously for 2 years. Now, as we look at income, we also compare income versus expenses, and we call that calculation debt to income ratio. It looks at pre-tax income versus expenses like credit cards and personal loans, auto loans, and the projected housing payment that you're going to take on. So when we think about the housing payment, that includes the principal and interest of my loan, property taxes, homeowners insurance, even mortgage insurance if I'm going to put less than 20% down. So as we analyze a client's expense structure along with that new projected payment, here's what it would look like. So if we looked at someone that had, let's say, a $2,500 housing payment, $500 in other debts, and they were making $8,500 in pre-tax income, that debt to income ratio calculation would tell us that that client's expenses with the new housing expense would consume 35.3% of their pre-tax income. And that's well within the guidelines. Actually, it's within this kind of the sweet spot or comfort zone for most of our clients. Most of our clients feel pretty good if their debt to income ratio is around 33 to 36%. Now, that debt to income ratio can go as high as 50%, not always favorable for most clients because that tells us that obviously you're maybe stretching yourself a little bit. But there's could be other income that we just can't validate, and that's what's pushing the debt to income ratio up. So it really just depends. For us, as we're building a plan for home ownership, affordability is more important, and that's a conversation I'm going to have with you during our one-on-one consultation, just to make sure that we've designed a home buying plan that really fits for you, that makes you feel like home ownership is sustainable. It's something you can do over a long period of time, in case you do have some cycles in kind of where you're at financially. Now, the last thing we want to think about when it comes to home ownership is savings for home ownership for the down payment as well as closing costs to buy my home. In this segment, what I'd like to do is just share with you what the typical sources of down payment are and then give you a savings plan around home ownership. Because when I think about home ownership for our clients, there's two kind of challenges that maybe hold us back from home ownership. It could be kind of where the market's at in terms of the cost of housing on your respective market. More often than not, though, it's really around savings. I just don't have enough money. Maybe I'm new in my career, I'm trying to get my footing with my job, but I just can't save up enough. I know I can afford the monthly amount, but I'm just not there from a savings perspective. We're going to put together a savings plan together in just a bit. Before I do that, I did want to pass along some of the documents or sources that we can use for asset verification. Obviously, checking and savings accounts can be used, but we just want to be mindful that cash cannot be used in validating for assets for buying a home. Retirement accounts, 401ks, 403bs, those can be used, brokerage accounts. I would just encourage you to talk to your financial advisor before you access those assets. That can obviously create potential tax burdens or pull money out of the market and you lose appreciation in those assets. And then gift funds can also be used for home purchase. That's an asset that does not require a seasoning like other assets that require a 60-day seasoning period. We just have a documentation process for those gift funds used by a family member. All right, well, let's talk about a savings plan for home ownership. And, as I mentioned, that's probably one of the bigger challenges to reach home ownership. We're going to spend some time looking at some assistance programs that are available to you as a prospective home buyer. But let's talk about how do we save for home ownership. And a savings plan will look a little bit like this. And I know we can kind of change these numbers based upon where you're at financially today. But let's say I'm renting for $1,500 a month, right? But after doing a virtual consultation with me, we feel like, hey, we can get to about a $3,000 housing expense budget. Now, that creates about a $1,500 surplus on a monthly basis. So, what I would encourage a client to do is on the first of the month, when I'm making that rent payment to my landlord and I'm paying that $1,500, create the discipline for yourself that you're putting another $1,500 aside that goes right to your savings account. Every month on the first of the month, an extra $1,500 goes right to your savings account. It's like you're making that mortgage payment, right? Because now I'm preparing myself financially that I'm accustomed to making $3,000 a month. So it doesn't feel like a big stretch when I eventually purchase my home. But what's the real important component of that is my savings is growing over time. After 6 months, I have $9,000 saved. After 12 months, I have $18,000 saved. And if I decide to park that money in maybe a high yield savings account, I'm also making interest on those savings deposits as well too. Really simple approach to saving, but it has been super effective for our clients. So I thought I would share that with you in tonight's class. Well, another resource that can get you closer to home ownership is first-time homebuyer programs. In the state of Mississippi, there's the MHC loan program that provides anywhere between $6,000 to $10,000 in assistance at a zero interest. There's also special incentives for teachers. And there's a mortgage credit certificate program that provides you a interest credit on the interest paid on your mortgage. Really great tool to help you as a first-time buyer. Within APM, we have a couple other programs that we offer. We have our 1% program, which essentially provides up to $4,500 in a grant as long as you contribute up to 2%. I'm sorry, other way. You contribute 1% of your own funds. We provide 2% to make up the full 3% in your down payment for your home purchase. And that is a grant provided to clients that make less than 80% of the median income. We also have a pathway program that doesn't have income limits to it, but on an FHA loan, it provides up to 3.5% to 5% of your sales price in assistance. So another great tool. Most first-time buyer programs offered all across the country are generally targeted to clients that make less than 80% of the median income, up to 150% of the median income in higher cost of living markets like California. All right, as we round out tonight's class, I thought I would share with you the buying process. Really, where do we go from here after attending tonight's class? This is our 6 steps of home buying, and it starts with probably the most important step is to meet with us for a consultation. So after tonight's class, hopefully you have a couple good takeaways after looking back at the recorded class and say, hey, you know what? I really want to get on this path to home ownership. I would encourage you to get connected with me for your one-on-one consultation. I meet with every client across our partnerships across the country for a 30-minute session virtually. We put a customized plan together for you around home ownership. You don't have to be looking to buy this year. Could not even be next year. It might be a couple years out, but we want to give you the good framework and guidance to home ownership. If you decide to get pre-approved, that pre-approval is good for 60 days. And then that kind of really launches you into step 2 of this buying process, which is the house hunting phase. Probably is going to start online, and then it will eventually transition to in person. We would encourage you to talk with a local realtor in your community. We have preferred realtors that we work with all across the country. So, you would want to get connected with them to help you with the house hunting search. Now, once you identify a few homes that really fit the criteria that you're looking for, let's say you decide to make an offer on one of those homes, right? And the offer gets accepted. Well, if that offer gets accepted, now we're going to keep on moving down this kind of path here. And we move to step 3, which is entering escrow. So that means you have a ratified contract with the seller, and that contract will have some timelines to it, which is the close of escrow date. Most transactions close in 30 days across the country, but other markets, it could be 45 or 60 days. Some of our more hyper competitive markets across the country, it can be as short as 14 days. But once we get word that your offer has been accepted, you're going to get a call from me saying, hey, congratulations, you did it. Your offer is accepted. Let's talk more about next steps, what you should expect as a buyer now working through the next milestones. We'll get your follow-up consultation set up for you. That's where I meet with all of our clients that are under contract just to make sure I have the financing detailed out properly. We'll go through timelines of the contract, all the important elements that make up your home purchase. So that'll happen. You'll also have some action items with your home buying checklist that we provide to you. And as a new buyer with a new transaction, you are going to be expected to make a deposit in the transaction, which is called an earnest money deposit. It ranges in dollar amounts in different parts of the country, but usually it's about 1 to 2% of your purchase price. That will count towards your total out-of-pocket expense. That deposit is going to be held by a title company, escrow company, attorney office, depending on what state you're in. And the contract will have some contingencies in it that protect that deposit. Contingencies around the appraised value of the home being supported by an appraisal report, or the purchase price being supported by an appraisal, getting your loan approved, getting your inspections done on the house. And usually those contingency periods are in the first 10 to 21 days of the contract period. As we move through these different milestones, step 4 is going to be like the processing and the underwriting of your loan, all of the administrative work, verifying your employment, verifying assets, getting everything prepared so we can move into the underwriting phase of things. And that takes us to step 5, where an underwriter has now finalized your loan approval. Also takes us about 3/4 of the way through the buying process. And at that stage in step 5, we're going to be preparing a closing disclosure for you, which gives you a final 3-day cooling off period before we move to step 6. Now, through every milestone in the process, you'll be getting electronic disclosure sent to you. You'll get disclosure sent to you after your follow-up video consultation with me. Once we lock in your interest rate, you'll get another disclosure that highlights your locked interest rate. And then at step 5, you'll get your final closing disclosure to start your 3-day cooling off period. Now that takes us to step 6, which is the closing of the loan. That's where we meet with an attorney or a title officer or a public notary to sign our final loan documents. That's the one thing next to, finding the home in person that you will have to do as an in-person activity. That day in most parts of the country, you're going to be signing documents the same day, delivering your final funds that are owed, and then we'll be wiring in your loan funds all in that same day. And then documents get recorded with the local county recorder's office. They'll record a grant deed to transfer ownership, and then they record the loan, signifying your agreement and your commitment to loan. Once we get the confirmation of those recorded documents, guess what? Now you're the new homeowner. And that is such a day of celebration for you. We couldn't be more excited for you to take you through that journey from doing it in more of a classroom setting to going down the path towards homeownership and then getting the keys to your home and firing up the moving truck and starting the move, right? Huge, huge, huge milestone in your financial futures. And we'd love to be a partner with you on that journey. But, as we help our clients across the country, our relationship doesn't stop there. We have an aftercare program that is staying connected with you with different financial tools like our HomeBot system to track home equity, our Rate Watch system. So if it ever does make sense to refinance, we're going to help you with that, and doing annual check-ins with our clients. So that's a really important part of our relationship beyond just your closing process. Now, if you're thinking about building your own plan for homeownership, I'd love to be a partner for you in that. It's a really simple process. It starts with an online application. We only do a soft credit check, and then you'll upload proof of your income and then use our scheduling system to schedule a video session, which is a 30-minute session with me. It's a one-on-one session. As I mentioned earlier, it's not about going out and finding a home right away. It's about just putting a plan together. So whether you're looking to buy in 2026 or next year or beyond, we just want to make sure that you have all the tools and resources to be able to set some proper goals for yourself around home ownership. This is what a consultation looks like for you. So we're going through a lot of the elements that you've heard in tonight's class, but talking about budgeting and location and interest rate climate, assistance programs, all the really important tools that you'll think you'll need on this path towards homeownership. And technology plays a big role in our process for our clients. It does not, however, replace the human side of things. So staying connected with you with phone calls or text messages, just talking you through kind of the process or concerns that you might have. We are always connected with our clients, but we definitely leverage mobile AI technology to give our best service levels to our clients. Part of our Mississippi State partnership includes a discount in our services. So we provide closing cost discounts, obviously the access to homeownership classes that you're attending tonight. So we want to make sure that we spotlight that as part of kind of our value add to our partnership with the Mississippi State Alumni Association. We do also have other partnerships across the country. So if you love what you heard this evening, I'd encourage you to share the content with your friends, family, coworkers. We do host over 60 classes per year. All of them are recorded up on our YouTube channel. So feel free to pass along that information. And of course, you'll get the recorded version of tonight's class in your email tomorrow from signing up for tonight's class. Well, as I wrap up tonight's class, I wanted to pass along my contact information. So if anything does come up that I can help answer questions for you, please reach out to me. Love to be able to hear from you. And finally, we love what our community says about us in supporting and educating in homeownership. We'd encourage you to check out some of our testimonials on our socials, whether that's in Reddit communities or on Instagram. I love what our community says about us because it tells us that we're doing the right thing in supporting our communities in homeownership. It's been a pleasure joining you in tonight's class. Hopefully you got a few things to take away on your path towards homeownership. I hope I get a chance to get connected with you very soon to help build your own home buying plan. Have a wonderful night, and we'll talk to you soon.